Bismillahirrahmanirrahim. Assalamu alaikum, dear students. Welcome again on another lecture related to monetary and fiscal framework in Islamic finance. As you know, this lecture series is coming from ComSat's Institute of Information Technology, Virtual Campus, Islamabad. The title of the course is MBF707. Today, we will study Islamic approach to money, banking and monetary policy, a review. Why a review? Review in the sense, this lecture has been prepared from one of the early contributions in the field of Islamic finance by Dr. Muhammad Nijatullah Siddiqui from India. Most of the components of this lecture have been extracted from the contribution of Nijatullah Siddiqui, and Nijatullah Siddiqui, as I usually say, he is parallel to Adam Smith in Islamic finance. He holds the position just like Adam Smith holds a significance in the conventional economic system. Well, first of all, I will share with you some of the points from the previous lectures, what we have done in the previous lectures. The topics which we covered in the last lecture include introduction of the Islamic funds, and in the line of Islamic funds, we discuss in detail equity funds, ijara funds, commodity funds, and in commodity funds and ijara funds, we had a talk as if these two funds can play a significant role in the mobilization of funds, and they can play their significant role in channelizing savings, converting savings to investment and capital formation of the economy, which intuitively built up the productive capacity of the economy through capital formation. This is what we discussed in the last lecture. Today, a few topics which were left over, which could not be covered on account of the time constraint, they are also in continuation of the Islamic funds. And these topics which we could not cover in the last lecture include Murabaha Funds and the next mixed funds, the blend of different types of funds. Now, first of all, Murabaha Funds. If a fund is created to undertake this kind of sale, which is known as Murabaha, it should be a closed-ended fund and its units cannot be negotiable in a secondary market. The reason is that in case of Murabaha, as undertaken by the present financial institutions, the commodities are sold to the clients immediately after their purchase from the original supplier by the financial institutions or the financier, while the price being on deferred payment basis becomes a debt payable by the client. Now, because of this very strong reason that the deferred payment is involved, which is in fact the cash to be paid in future in either installments or in full, in 2 units, 3 units, 4 units, depending upon the convenience of the buyer or the client. That is why the sale in the secondary market or in the stock market is prohibited. Murabaha funds, continuing, the portfolio of Murabaha does not own any tangible assets. It comprises either cash or the receivable debts. That is another reason for Murabaha certificates or Murabaha sale not to be admissible for sale in the secondary market. If they are exchanged for money, this will definitely give rise to the surplus amount, which is known as riba. Now, if it is offered at the price lower than that, then again it is riba, but it is negative riba. And if at all it is needed to be sold or exchanged or traded in the secondary market, then the only possibility of trading such Murabaha certificates or claims is to be purchased or sold at par value. Now, continuing the Islamic funds, the mixed funds. This is very important concept in Islamic financial system, where the funds, the permissible modes of financing from variety of sources with different names and nomenclature can be clubbed for the facility of different economic activities associated with the financial modes of finance. Now, when we say mixed fund, it can be a portfolio of multiple funds. It can be the combination of Mudarba and Musharaka fund. It can be the combination of security or equity fund and the Murabaha fund, or it can be the combination of any other two types of funds. In this case, the tangible assets of the fund are more than 51%, while the liquidity and the debts are less than 50%. If this is the case, if this proportion exists, 51, 49, 52, 48 or more than 50 on the part of non-liquidity and the tangible assets and the rest in the liquidity form, then the certificates of mixed fund are tradable in the secondary market because they are asset-backed certificates or shares. The units of the fund may be negotiable. Particularly they are negotiable when they are asset-backed, and when we club together different types of funds, we develop a portfolio. Most of it is asset-backed, and that is why they are negotiable, because on the back of these certificates, the goods, the tangible items are being traded, and during the trade period, the prices may go up, prices may go down, but most probably, if the economic activities are stable, then the profit level or the price plus margin is likely to increase all the time at the very slow rate, but there will be some addition to the existing price. So that is why when they are negotiated in the secondary market, their certificates prices values are also likely to increase, giving a rise to the capital gains. Dear students, now we have reached the point of concluding different types of Islamic funds which we have been discussing for the last 2-3 lectures. We discussed in the line of Islamic funds how to generate funds, how funds can be generated. Then at length we studied how to make plans and projects in order to utilize these funds which are generated, and how to channelize these funds, or how to channelize deposits, or how deposit mobilization can be brought about. Then we also discussed at different stages with reference to different types of funds how economic and financial development process can be vigorated, can be increased or enhanced with the help of these Islamic funds. How to generate funds? We discussed different contributors can contribute their funds in a pool which can be given different name. If this pool is meant for Murabaha purpose, it can be known as the Murabaha Fund. If it is for the purpose of engaging the equity related activities, then this pool of fund can be known as the equity fund. And if the purpose of generating this pool of fund is to engage in some portfolio or the mix or blend of different types of fund, then it can be known as the portfolio fund or the mix fund. Then at length we studied and discussed how to make plans and projects. Obviously, when the funds are pooled, when a pool of fund is generated with any name, the ultimate objective is to productively utilize these funds. Now, in order to productively utilize these funds, Islamic financial system should prepare different types of projects with their appropriate feasibility, with their cost and benefit analysis, with the market history of different projects, which can be used as a sample or precedent in order to launch some new projects. So, if there are new projects, new plans, only then the funds which have been pooled can be utilized productively. Otherwise, the greater portion of these funds will remain idle or unutilized, which is again the problematic situation in Islamic financial system. So, in the Islamic financial system, the monetary side must be completely linked with the real side. That is why if the pool of fund is being generated on the other side of the equation, there must be projects and plans to be launched with the help of these funds. Now, how to channelize these funds? We discussed different ways to channelize these funds. It can be through equity, it can be through Murabaha arrangement, it can be some other arrangements which we have been discussing from time to time. And last but not the least, in the line of Islamic funds and its utilization, the economic and the financial developments. Channelizing funds, making projects, planning the investment of funds for these projects, and interlinking these funds with the potential projects, with the existing projects, with the purpose of growth, the process of economic development and financial growth can be accelerated, can be enhanced. So, if in an Islamic framework we want to achieve the objective of economic development, high economic growth, the financial growth of the companies, financial growth of the business enterprises, there is need to generate fund. And this pool of fund, there's a lot of possibilities and avenues through which the fund can be pooled and a portfolio of the projects can be made for the purpose of economic development in an Islamic economy. Dear students, with these words, we are now ending the topic of Islamic funds, their utilization for the purpose of economic development and financial growth. Here we conclude this topic, and now the topics of our discussion for today's lecture is in fact the Islamic approach to money, banking and monetary policy. What is the concept of money? What is the concept of banking? What is to be the monetary policy to implement in the macroeconomic system of Islamic economy? A sort of review is being presented. As I mentioned earlier, in this lecture we will be focusing on one of the earliest approaches to develop the concept of money, to understand what is monetary policy, how to implement this monetary policy, how to link monetary policy and the banking system of Islamic economy with the international economy. Because an Islamic economy cannot be a closed economy, we cannot remain cut off rest of the world. Every Islamic economy is supposed to be an open economy, having good trade relations with the rest of the world, because openness nowadays is the slogan of economic growth and economic development. And in the era of globalization, expanding globalization and decreasing trade barriers and non-trade tariff barriers, there is a need to develop the trade and economic linkages with the rest of the world. And obviously an Islamic economy cannot remain separate or independent of rest of the world. Well, students, now starting this topic, Islamic approach to money, banking and monetary policy. First of all, an introduction. As I mentioned earlier, these are the topics which will be studied in the line of money, monetary policy. We'll discuss what is the concept of money. Is it the traditional concept that money is the medium of exchange, store of value and unit of account? And this has to be discussed in detail. What is the concept of interest-free banking? How the interest-free banking will function when the conventional banking system is holding very strong, deep-rooted history in the Islamic countries, in addition to the conventional countries of the world. How monetary policy can function, and how international banking can be launched and can be put on strong footing in line with the monetary policy of the Islamic economy. And then in the end we will discuss a few conclusions. I will share with you some of the findings of the study. So, viewer introduction. What is money? Money is part of the economic activities in the Muslim countries since its inception. Islamic countries did not remain independent of the concept of money. Money has been from its inception in Islamic countries, and it has been playing the same role as in the conventional economic system. So the concept of money is not new to the Islamic world. The emergence of modern banks and the other financial institutions in the Islamic countries, for example, the paper currency, the increase in public debt and the commercial dealings in the security, presented a lot of challenges to the jurists. A number of questions were raised, and Islamic jurists and Islamic economists, joining together, tried to answer these questions, which were in some cases difficult to answer. The emergence of modern banks and other financial institutions in the Muslim countries, the introduction of paper currency, the increase in this is the repeated statement. It was basically copied twice. Now, the juristic debate is not the subject matter of our discussion. We have already done juristic discussion from the books of the Islamic scholars, the religious scholars, in the field of Islamic economics and Islamic finance. Our today's lecture will not focus on the juristic debate, rather the debate will be the crux of discussion among the Islamic economists instead of just jurists. So our focus is the very recent writings, mostly by the economist. On the nature and the role of money, our discussion will focus on the nature and the role of money, banking free of interest, monetary policy in an Islamic framework. So this is what we are going to discuss in the next couple of slides. Now, money. Money as a medium of exchange greatly favors the transition from barter to money economy. There were a lot of problems in the barter trade. The barter trade was common to all the countries, including the Islamic world. And you know, the barter trade had a lot of troubles and problems. For example, while exchanging goods for goods in the barter system, it was time-taking process. Secondly, it was difficult to find out the relevant customer or the relevant seller of the product which you are in need of. And another problem was the smaller units. The sum of the goods were not divisible into smaller units, and therefore the barter trade could not be completed in accordance with the desire of the two parties, sellers and the buyers. In fact, in the barter trade, both the parties are the sellers, both the parties are the buyers. One party is buying one commodity and selling the other commodity. The other party is buying another commodity and selling the alternative commodity. Prohibition of interest. So money was introduced as a medium of exchange to play the major function as medium of exchange. And in convention system, it also holds the other two functions, unit of account and the store of value. Just to remind you, in the conventional setup, when we say medium of exchange, it means money is acceptable in the transactions. It facilitates transactions. When you buy goods, you pay money, and it is accepted by the seller of the product. And when you sell any service or good, you receive something which is acceptable to you. That is why you are selling the product. This is a function of money as medium of exchange. And when we say store of value, it means transfer of value of money from current period to the future period. So 500 rupee note will remain 500 rupee note tomorrow, and its value is maintained. But even in the conventional system, the store of value, the function as a store of value, is challengeable. Why it is challengeable? Because of the inflation, the value of the money does not remain constant. Money changes its value, and obviously because of the inflation, purchasing power of the existing currency notes is decreased. A 500 rupee note or 1000 rupee note or any other currency note does not continue buying the same products by the same amount, by the same quality. So money as store of value is challenging. Particularly, it is challenged by the Islamic economist, because if we believe that the value of money remains the same, then there is no justification of interest even in the conventional system. And in the conventional system, one of the determinants of interest is inflation. Since money loses its value during the process of loan, during the period when money has been lent out, money loses its value, and in order to compensate the value of money, the interest is justified. This is one of the reasons for considering money as a store of value. The third concept, the third function of money is unit of account. Money is used to compare the values of different products. For example, how many units of one product can purchase the units of certain other product. It is because of money. Money is used as a benchmark to compare the values of different products, and we can tell with the help of money that 2 motorbikes or 3 motorbikes are equivalent to 1 car. It is on account of the money as a unit of account. Now, prohibition of interest was considered vital for freeing the money economy from injustice and exploitation and making it rational. Now, as I mentioned earlier, when we go into the details of the functions of money, particularly the function of money as a store of value, and this creates the concept of interest, this is a system of injustice. Injustice in the sense, suppose we are borrowing money from different sources, and we have to, for the purpose of consumption. So in order to meet the consumption needs, we are borrowing money, but the injustice is that tomorrow we need to return more than what we have borrowed in order to meet our basic necessities. Justice and efficiency consideration, and because of money as a transfer of value from one period to another, which is in fact time value of money, with the involvement of the concept of time value of money, the inflationary situation has created inefficiency in the system. And the Islamic system of finance claims to have provided justice, equity and efficiency to the economic system. That is why, in order to ensure justice and efficiency, which is the demand of the Islamic financial system, money should play its neutral role. And the neutral role can be associated with the abolition of interest, and the abolition of interest is must if we want to see the neutral role of money. Now, advantages of money include its liquidity premium, but no carrying costs. Its elasticity of substitution is 0, so that a rise in its demand must raise the rate of interest. Now, this is a sort of an argument as to the generation of interest. One of the advantages of money is that it is the most liquid form of asset, and it includes liquidity premium, but there is no carrying cost. So if we are carrying cash, there is apparently no cost involved, but since money has no elasticity of substitution, the elasticity of substitution is 0. It means there is no alternative to money in the modern system. It is money which is used as a medium of exchange, and there is nothing else to be used as a medium of exchange. So if in this context the elasticity of substitution is 0, that is why whenever there is elasticity of substitution equal to 0, whenever there will be increase in demand for such a product for money, there will be increase in the price of money or such a product. So that is why when there is increase in demand for money, the rate of interest is likely to increase. Now, when in Islamic framework, the objective is abolition of interest, the prohibition of interest. Obviously, when interest is removed, the liquidity premium will also be removed. Dear students, if liquidity premium is not existing, now here the question arises whether interest is the cause or the effect of the liquidity premium. In fact, it is not the cause, it is the effect of the interest. Now, that clearly indicates the speculative demand for money is at the root of the instability in the demand for money and is the cause of trade cycle. So, what is speculative demand for money? When more cash is demanded as the interest rate is decreasing. Now, the negative relationship between the interest rate and liquidity demand for money is itself debatable in the conventional system. For example, Friedman is against this liquidity preference theory. There is controversy, classical and Keynesian controversy, which clearly singles out a dominating view of the Friedman, Milton Friedman. Now, Friedman is of the view, if you read the book of Ledler, The History of Monetary Theories, in chapter 4-5, you will find a very dominating view of the classical economists and the new classical economists, that people are not fooled when price is decreasing, when interest rate is decreasing, and people will not continue holding cash with the expectation of rising interest rate in future, and then they will earn some premium. According to Friedman and the supporter of his theory, if people are holding cash, if more cash is being accumulated, obviously this cash will not remain idle. Rather, it will come to the system through more consumption expenditures, and this will automatically raise the demand for goods and services. So this was in fact a challenge to the liquidity preference theory by the classical economists themselves. Now, basically, the liquidity preference theory or the speculative demand for money was the explanation given by the economist for Great Depression, when money could not play its role in the revival of the economy. So whatever money was supplied, it was held by the people, and people did not reinvest. People did not invest in the economy. Although the concept was that when interest rate is falling because of the recession, so it is not appropriate to buy bond, and when in the future, so people accumulate cash. If people expect higher interest rate or rising interest rate in the future, they will wait till the interest rate starts rising and the price of bond decreases and people buy more bonds for the purpose of capital gain. In Islamic framework, the argument is not like the Friedman's argument, that the idle money held is ultimately consumed. No, this is not the argument. In Islamic framework, the zakat levy is one of the encouragement to keep money other than idle, to keep money in the form of investment or in the channel or in the mode where money does not remain idle. The 2.5% per annum zakat levy is regarded as a measure ensuring a carrying cost. So zakat, the rate of zakat is considered as a sort of cost on the idle cash. The term carrying cost has been used in parallel with the conventional economic system, conventional financial system. Otherwise, zakah is an obligation. Zakah is one of the faraiz, which has to be performed. Zakat has to be paid by sahib-e-nisab, and there is no escape because one of the caliphs even started war against the people who refused to pay zakat. So in monetary system, this 2.5% levy itself is the concept of dynamic utilization of the funds which cannot be kept idle for a longer period of time. So abolition of interest and the imposition of zakah would thus ensure that money serves its primary function of a medium of exchange. Although the concept looks similar to freedmen, as if when money is accumulated by the people, people will not keep this money idle, they will bring it back to the consumption pattern and the business cycles have to be reinvigorated. Savings, dear students, saving will have to be invested in common stocks or deposited in the profit sharing accounts. This is the concept obviously which does not exist even in the freedman argument. Obviously we do not expect such concept from freedmen. We expect such concept from the Islamic system of finance, Islamic economic system, where the believers believe in the system, Islamic teachings and the Islamic modes of finance. People will still hold cash in expectation of a rise in the expected rate of profit or in anticipation of better investment opportunities. This is one of the possibilities, that people are accumulating cash, but they cannot accumulate cash for a longer period of time because they would have to be levied zakah at the rate of 2.5%. Now, what is the alternative if they are not keeping cash in idle form? The alternative is either buy stocks or deposit in the bank in the PLS system according to the profit and loss sharing arrangement, or wait for the better investment opportunities and invest where the profit earning is probably higher than the existing one. This means the speculative motive will still exist even in the Islamic financial system. So it is operative, speculative motive is operative in the Islamic economy, but indeed this speculation is different from the conventional system, where the entire emphasis and the focus is on the earning of interest, either through sale or purchase of bond or through giving and taking loans. But here the direction of speculative motive is different in the sense that the Muslim savers will either continue exploring the better employment opportunities for their funds for the purpose of investment, but this is not bad because this is the dynamic objective of the savers in Islamic financial system, but it will no longer be capable of generating the wide fluctuations experienced in the existing financial system, in the existing, with the existing concept of money. Dear students, excuse me, here if in the conventional system it creates a lot of fluctuations, the holding of cash as one of the arguments for one of the reasons which have been shared in the economics literature for Great Depression. It was due to the speculative reason, the speculative attitude of the people. So if the government continues increasing money supply and people continue holding it and nothing comes back to the system in the business cycle activities, ultimately every unit of money is held and nothing comes back to the system, and the economy is stuck in the depression, which was later on declared as the Great Depression. But here it is not the case. So if money is held in search of better opportunities, not with the objective of keeping it idle for a longer period of time, then I think this is again a dynamic objective, one of the dynamic objective. So fluctuation in profit expectations may be counterbalanced by the expectation of losses as well, because if the depositors, if the savers in the Islamic framework are in search of the opportunities which may accrue them profit, at the same time they should also expect any possible loss which they may encounter after the investment is undertaken. So both will definitely balance and counterbalance each other, and the rate of fluctuation will not be as much as in the conventional system, where interest is the major cause of fluctuation and depression and recession. There will still be a need for monetary policy to ensure stability. That doesn't mean at all that if the definition of money is changed and there is no more need for the monetary policy, this is not the case. Monetary policy will still be need of the economy. So abolition of interest will curtail the harmful features of the credit creation of banks. There is no doubt about it, because credit creation itself also causes the inflation by multiplying interest, multiplying the same fund from one account to another, from one bank to another bank. So through this credit creation process in the conventional system, there are less chances of increasing assets, real assets, monetary assets, of course, in the books are created, but this credit creation process creates a sort of inflation in the economy, because the real sector is not increased, the real sector is not linked with the credit creation. So private commercial banks will still cause credit creation in an interest-free banking system. However, credit economy is in fact inflationary economy. That is why in Islamic financial system, in Islamic monetary system, the over expansion of the credit will not be possible, because the amount of money will be either invested by the banks, or there will be two-tier mudarba system run by the financial structure of the economy. So over expansion of credit generally causes easy banking profit leading to downturn and the depression, as I mentioned earlier. Dear students, continuing further concept of money, in the interest-free system, credit would be created only to the extent that there exist genuine possibilities of creating additional social wealth through productive enterprise. Such a concept does not exist in the conventional system. So credit will continue to be created even after the switchover from interest-based to interest-free system of Murabaha or profit sharing as the basis of the bank advances to businessmen because of the people's habits of saving part of their income in their deposits. So depositors basically they want to earn profit, and the financial institutions have to transform their functions in the best interest of the depositors. And they have to play, as I mentioned earlier, they have to play their role in the framework of two-tier Mudarba system. On one side, they will be dealing with the depositors. On the other side, they will be dealing with the investors. So in this two-tier system, definitely the fluctuations can be controlled, because on every stage the assets are on the back of investment or the creation of credit. Students, if commercial banks were to, just one view of the earlier Islamic economist was that the 100% if the commercial banks were to operate with 100% reserves, this was one of the options, one of the options of Islamic economists and Islamic financial experts, that there is 100% required reserve ratio should be used in order to create credit, in order to create money in the economy. But this point of view was later on rejected, and if the commercial banks were to operate with 100% reserves, their only earnings then would consist of service charges on checking deposits, fee charge for the transfer, safekeeping and other services. It means if 100% reserve ratio is used, then what would happen? The role of financial institutions or the commercial banks is reduced to minimum level, and as I mentioned in the slide, that the banks then would be functioning for receiving or paying the service charges for the services which they are providing for the safekeeping of deposits of the money, for the transfer of money from one monetary center to another, from one trading center to another, and but this is very limited role. If financial institutions are given such a role, this is very limited. Such a role cannot play its significance in the economic growth and the economic development of the country. Therefore, this proposal of 100% reserve was rejected by the Islamic financial experts and the economists. The establishment of finance houses for handling Murabaha funds for investment on a profit sharing basis can be one of the solutions. If the 100% reserves are not used, then one of the options which was explored and which was introduced is that Murabaha houses, finance houses can be developed. Dear students, you remember in the last lecture we discussed the Islamic fund system. So this is similar to Islamic fund system where finance houses can be established, and these finance houses can be even the financial institutions who can play their role in handling the Murabaha funds. As I mentioned earlier, the two-tier Murabaha system can be handled by the financial institutions, and it can be very useful. Now, summing up the concept of money. So, in the interest-free economy, the speculative demand for money is totally different from the conventional system. It is neither, this concept of money is neither similar to Keynesian system of money demand, and nor is it similar to the Friedman system. In Keynesian system, the speculative demand for money is negatively sloped, and there is very strong concept of liquidity preference, which ultimately turns out to be liquidity trap in case of depression. So depression is explained, Great Depression, the economic depression and the economic recession is explained with the help of the liquidity preference system, or the demand for money which is negatively sloped. And while in counter arguments for money, Friedman and his colleagues, his supporters, his contemporary supporting him in his field, they are of the view that the people are not foolish to hold huge cash and continue accumulating cash more and more. This is not the case. One of the possibilities Friedman and the other economists share, that if people are accumulating more cash, then this cash motivates them to spend more. The economy again has potential to come out of Great Depression, and the Great Depression was not possible. In Islamic framework, there are so many other alternatives. People can deposit money for profit and loss sharing with the financial institutions. They can buy stocks, shares. So the volatility is reduced to the minimum possible level if these definitions of money and these functions of money are considered in Islamic framework. Dear students, this is the concept of money in Islamic framework. Now we are moving to the next our topic of interest-free banking in the system of monetary policy. Interest-free banking. At length we have discussed different modes of financing as an alternative to the interest-based funding system and the interest-based investment system. I think you remember all of them. We discussed the alternative modes of finance to the interest-based system. And these were Murabaha, we discussed Salam, we discussed Ijara, we discussed Istisna, we discussed above all, we discussed Musharka and Mudarba system, and how Musharka and Mudarba can be one of the most productive system of investment and financing in Islamic framework. So now we are on the side of the economist in the line of Islamic finance. So interest-free banking. A bank, what is bank? Bank is conceived in the first instance as a financial intermediary which mobilizes savings from the public on the basis of mudarba and advancing capital to entrepreneurs on the same basis. Now, as I mentioned earlier, there are so many ways the bank can play their role in Islamic framework in the interest-free banking system. We have discussed the multiple alternatives of interest-based system. Earning allowance for administrative cost, this is one of the income source of the interest-free banking system. So if they are safekeeping the deposits of the depositors, definitely they reserve some rewards because they are providing security to our money, number one. Number two, they are the source of channelizing these savings. Obviously, if the depositor's objective is not to keep deposits as idle, then the alternative possibility is the depositors give different options to the financial institutions for the purpose of investment or contributing his deposits to the funds with different titles, maybe the equity fund, maybe the Murabaha fund, maybe the depositor wants to contribute in terms of some other fund, maybe commodity fund. So, well, viewers, the students, so administrative cost is justified on the grounds of providing safety to the deposits and promising the timely return of these deposits to the actual owner. In interest-free banking, the other earning sources are from public deposits on the basis of Murabaha and share capital. How Mudarba and Murabaha and the share capital, how banks can generate earnings, profits from deposits. Obviously, when banks are gathering, when banks are the custodian of lot of deposits from the public, and the depositors know different options, different alternative of investment of these deposits. Banks, while contributing part of their fund, certain proportion from their own in the major pool of deposits, can launch Mudarba activities, can buy different products and sell them on the basis of Murabaha. They can sign the agreement of funding Salam as a mode of finance, and they can also engage themselves in istisna. These are different. And from all these different avenues, from all these investment avenues, from all different modes of finance, the banks are generating money, generating profit, and these profits are distributed among the shareholders in accordance with the agreed formula which is publicly announced by the banks. In interest-free banking system, the banks can open current accounts where no interest is paid. Again, this is the function similar to safekeeping of deposits, safekeeping of the funds, for which the bank can charge its administrative cost or the security expenditures. Now, as I mentioned earlier, while defining and explaining the concept of money, basically the interest-free banking is based on two-tier Mudarba system or two-tier Mudarba contract. On one side, they receive money from the depositors. On the other side, they are contacting the investors or the managers of the business or the enterprises. So in this two-tier system, the banks are generating economic activities. Not only they are generating activities, but they are also source of generating profits which are earned and later on distributed among the shareholders and the depositors. Basically, the two-tier Mudarba system was good, and it is good so far as the profits are earned and profits are generated. But what if the loss is suffered? If on different projects or in some of the projects the loss suffered? This was a challenge, and this is still challenge to convince the depositors that in case of loss, how the loss will be shared, and the depositors are very touchy, very sensitive about the word loss. Dear students, depositors want to be sure of getting their deposits back in full, if not with any profit. But the word loss is not in their dictionary. But this was a challenge for the Islamic financial experts, and some solutions, some answers have been gathered, and these answers are: number one, the banks diversify their portfolio. They should invest these deposits in multiple projects. In case if some of the projects accrue losses, some other projects can be profitable, because all the projects cannot be cannot suffer losses. In some of the projects, the profits will be generated, in some other the loss. So the loss can be compensated by the profits generated in some other projects. This is one. Number two, the banks can generate a fund, can build a fund which can be known as the loss compensating fund or loss compensating reserves. How this loss compensating reserve system or the loss compensating fund can be generated? At the time when banks are earning huge profits from some of the projects, certain proportion of these profits can be endowed to, can be given to this pool which is known as loss compensating reserves. These loss compensating reserves may accumulate over years with the banks, with the financial institutions, and whenever there is possibility of loss, and whenever the loss is materialized or experienced in any of the projects, in order to build the confidence of the depositors, the financial institutions can compensate them either in full or in part, and even in some cases, if they are not offered loss, but they are given at least full money which they deposited, if not the extra profit. This is how it can be generated. This is one of the opinion to introduce such loss compensating reserves. Another suggestion is that the deposit insurance scheme may be launched with the backing of the central bank and participation of all banks and their depositors. This would be a sort of pool under the umbrella of, with the permission of the central banking system, with the permission of the central bank of the country. All the banks functioning, operating in the economy can develop a pool of loss compensating reserves, loss compensating funds, and they regularly continue contributing a part of their earning or certain portion of their profit, but all this should be clearly announced and disseminated to the public, particularly the interested depositors and the interested investors, so that in case of loss, the system of banking should be able to compensate this loss and avoid any recessionary or depression situation in the economy. This is how the financial system in interest-free banking can function more successfully, more productively, and more safely. But the issues, there are certain issues which need attention. We will discuss these issues in the next lecture. Dear students, we conclude our lecture here. Actually, this topic is spread over 2 to 3 lectures, and we have covered part of it in the first part of the lecture. We reviewed the last lecture about funds, and then we shifted to the topic of Islamic approach to money, banking and the monetary policy, a review. We discussed different options of money, its properties, its functions, how these functions are different from the conventional system, and what can be the possibilities of mobilizing funds. And then we studied the interest-free banking, the possibilities of interest-free banking, and how interest-free banking would be different from the conventional system. Dear students, we complete this topic here, we stop here, and in continuation of this topic, we will start our next lecture, inshallah. By then, goodbye, Allah Hafiz.